Oh, that's great. It's got me with my middle finger out. It froze like that. Yeah, this is what I think. Okay, y'all. Now we're in first class. Okay, so we're looking at corporations this chapter. This is it? No, that's chapter 2. This is yours. You need to come forward. Well, 3. Okay, so corporations are like totally different types of entities than partnerships. Corporations have some benefits, and then they have some things that aren't so beneficial. Stacie, if you want to look at the test, I'll let you look at it. Did you lose your page 1?
Yeah, my page 1 got wet.
I don't have just page 1. You can have this one, and I probably won't need it. I always make extra copies. So. Okay, so some of the benefits. There's limited liability. So it's not like a partnership where if something happens, you personally are liable for it. And, so there's that protection. So I think we had talked about last chapter that, partnerships you're kind of vulnerable from a legal standpoint from liability. You're vulnerable to liability. And then the LLC it takes the good things about a partnership and the good things about a corporation, and it kind of gives you the best of both worlds, because corporation's a little bit more difficult to form. It's got a lot more paperwork, a lot more pieces, a lot more requirements. So it's just a little more troublesome to have than an LLC. One thing I want you to make a note of, what we're studying in this chapter is equity financing. So just kind of write that somewhere. Okay, so a corporation is its own legal entity. It's almost like a being. It can own property, get rid of property in its name. Like the corporation itself can own property, land, buildings, vehicles. It can enter into contracts. Of course, a human has to, facilitate that process, but it can be done under the corporate name, which provides liability protection to the owners. Another good thing about a corporation is that ownership can be easily transferred through selling shares of stock. So let me back up. Ownership is achieved. You become an owner by buying shares of stock. So stock ownership is ownership of the business. So if you were to go out and buy, I don't know how much Nike's running right now. I might hate Nike. If you were to go out and buy 10 shares of GameStop just to get on the bandwagon, you would become an owner of GameStop. You might be a very small owner in GameStop, but you'd still be an owner. So that's how you become an owner in a corporation, is by buying shares of stock. If you have some shares of a corporation, you are a shareholder or a stockholder of that corporation. That's what you're called. Corporations have the ability to raise large amounts of money by selling stock. So when you see the word capital here, it's the equivalent of money. They're talking about money. The corporation is essentially run by the board of directors. The day-to-day stuff is done by officers, but the board of directors they're kind of like the monarchy, I guess. They kind of sit over everything and, make sure that the policies are what is best for the company and the procedures and that sort of thing. And they're elected by the stockholders. Okay. All right, so any corporations that sell their stock on the stock market, those are public corporations. There's plenty of corporations that don't sell their stock publicly, they're private. All right, and the private ones are usually owned by a small group of people. You might hear them called closely held corporations. Income's distributed by the way of dividends. There is one negative to the corporate structure. Yeah, double taxation. So think about it like this. The corporation itself pays income taxes. You know, when you have a partnership or proprietorship, that net income from that business, the individuals that own it recognize their share of the net income on their own tax return and they pay the tax. Well, a corporation pays, it pays income tax. So if they're already paying income tax on earnings, and then they distribute earnings to stockholders by way of dividends. Think of dividends kind of like owner's draw. It's not an expense. It's going through equity. So it's not going to be reducing net income. And so the corporation has already paid tax on earnings. And then when the stockholder receives dividends, they have to pay tax on those dividends. So it's getting taxed twice. It's money that's getting taxed twice. That is a disadvantage. All right. The reason I told you equity financing, selling stock is a way for them to raise money. We already said that. And they're selling shares of ownership, which is equity. So we're going to look at debt financing in the next chapter. So I kind of wanted to differentiate that. All right. So if you're going to form a corporation, you have to file an application with the state. So in our state, we would file an application with the Mississippi Secretary of State's office. And laws for every state differ. Some states make it easier to form than others. You'll see, well, you may or may not see. One thing I noticed when I was doing tax work was that a lot of corporations, they put in the application for organization in Delaware. Apparently Delaware has very favorable corporate laws. So it's kind of funny. It doesn't matter where you incorporate, you can do business anywhere. You just have to file paperwork with the Secretary of State getting, permission, so to speak, to do business in that state. You have to register in that state to do business. So they can track you and collect sales tax or whatever, income tax. Okay, so that's why you'll see corporations organizing in weird places. Is because of the favorable laws. All right, so what happens when you put that application in with the Secretary of State? They grant you a charter. So you'll hear charter is interchangeable with articles of incorporation. It's the same thing. So once those articles of incorporation or that charter is issued by the state, then the corporation is created. It's formally created. So once that's done, the board of directors will write bylaws. So bylaws are the rules and procedures for the corporate operations. All right, this is something you need to pay attention to here because you're going to have this on a homework. I'm not sure if it's this one or the next one. I think it's the next one. Costs incurred by the corporation to organize. Could be legal fees, taxes, state and corporation fees, license fees, etc. Those are going to be expensed as organizational expenses. I think it's when we do part 2 where we're issuing stock, you're going to have a problem where it says, like in exchange for legal fees, they gave their attorney stock. So in exchange for doing all this stuff for them to get up and running, their organization fees, they traded. They gave him stock, he gave them services. So instead of calling those legal fees, you're going to call them organizational expenses. So just keep that tucked in your mind because when you're doing that problem, you're going to be pulling your hair out trying to figure out where it goes. So just mark it. Stockholders' equity, That's like our owner's equity. We had, John Doe Capital, or in a partnership, partner A capital, partner B capital, whatever. So stockholders' equity is the owner's equity of the corporation. There's a lot of pieces to it, though. It's not like our owner's equity where we just had capital. We're going to have several different sections in there. So just get your mind right for that. All right. It's called shareholders' equity. You might hear it called shareholders' investment or capital. And two main sources of that stockholders' equity are paid in capital and retained earnings. Where is it? Yeah. Okay, this stuff is boring, but it's stuff you're going to have to know for multiple choice. And just make sure you got all your answers filled in. Where this comes from, this paid in capital, this contributed capital, that's money that's money from stock sales. And we're going to learn about two different classes of stock, and there's a separate account for each one of those. Retained earnings, think about that kind of as the equivalent to our owner's capital account, because your net income goes in there, the dividends offset it, and it grows with net income, it shrinks with net loss, and every time dividends are paid, it goes down. So think about dividends like draws. Dividends are real similar to draws. All right, dividends are how corporate earnings are shared with shareholders, distributed to shareholders. Retained earnings is just what it sounds like. It's earnings that are kept in the business, retained in the business. They're increased by net income, decreased by net loss and dividends. We just said that. It normally has a credit balance. If it has a debit balance, we got a deficit. That's not good. And take note that the balance in that retained earnings account, which is similar to our capital that we're used to seeing, it is not the same as cash. That number is not going to be the same amount as what you got in cash. You may see that as a true false or something. You may have already seen that as a true false. All right. The charter. It's gonna state how many shares that corporation can issue. So those are authorized shares. Now that doesn't mean, when I say issue, it's the same thing as sell. That doesn't mean the corporation is going to sell that many shares. It just means they can. They have the authority from the state to do that. So you're going to hear the terms authorized, issued, outstanding. Authorized means that's how many they have permission to sell. Issued means they've actually sold those shares. Somebody's got them at one point. And then outstanding means how many are still out there in the hands of shareholders, because the company has the ability to buy those shares back if they want to. But issued means at one point they were sold. They may be back in the hands of the corporation now. So outstanding means how many are in the hands of shareholders. Y'all lost, are you bored, and you tuned out?
So if they want to buy back their shares, do they have to get permission of the shareholder to buy it back? Or
If they're out there on the market for sale or purchase, the corporation just buys them back.
Okay.
They're just like any other buyer, because it's open market. So, all right. Shares of stock are assigned a dollar amount. Often, not always. It's called par value. It's just an assigned amount. It's not necessarily how much they're going to sell for. They might in the beginning, but hopefully the price of it will increase, as the business starts to do better. It's just an assigned value. It can be $1. It can be $10, $20. It just depends on what the company assigns for value to it. It really doesn't represent market value. What it does is help us to record the entry on the books. Is what it's there for. All right, so stock that does not have a par value is called no par stock. But some states require that you have some sort of value on it, so you may see stated value. You're going to treat stated value just the same way as you treat par value. These are things we're going to go through examples to get this stuff to stick, so don't worry. I don't like this part. I don't like going through this kind of stuff because I know y'all are bored. All right. The rest of it you can just kind of read through about the minimum amount of money they have to keep in the company to cover creditors. So there's rights that shareholders have: right to vote in corporate matters, right to receive earnings or dividends, and the right to share in the assets if the company liquidates. So essentially, all these shareholders might lose is their investment in the company. So you're not going to be strapped with any liability if you're a shareholder, but you might lose what you had in it. So that was kind of what was so bad about that whole WorldCom fiasco. A lot of folks bought into it, and then it went, there was fraud, and it went belly up, and they lost everything they had put into it. Some of the people had their entire retirement fund invested in it. So they might have been working for 30 years and have $100,000 or more in their retirement account, but they used all that money to buy shares of WorldCom. And when WorldCom went bankrupt, they had nothing. So they went from this to nothing. That's kind of bad. So, that was one of the things I was telling y'all when we were talking about ethics and fraud and all that. Or was that's accounting one, but I did tell y'all about accounting one. It's a corporate fraud, so it applies. But, yeah, that's bad. So, there might have been a liquidation, but I doubt the shareholders got anything. The creditors probably got it all. So I think ultimately the shareholders got a little bit, but it was nothing compared to what they had invested in it. Okay, so we're going to look at two primary classes of paid-in capital. We got common stock and preferred stock. So that's the classes of stock we're going to look at. Common stock is the kind of stock that if they don't have any other class of stock, they got common. The other one is preferred stock. So that's got a little more, usually it's more expensive, and it's got a little bit of priority placed on it. So with preferred stock, if the company pays dividends out, the preferred stockholders are going to get paid first. And it's stated on the shares how much they can expect per share to receive. And we're going to go through those examples. All right, so the preferred shareholders have a greater chance of getting dividends. There's two ways those may be stated, the rights in dollars or percentages. We'll look at that. Cumulative preferred means in years that no dividends were paid out or declared, that whatever their rights were in that year, it's kind of like carrying your balance forward. So if they don't get paid, then whatever they didn't get paid goes to next year and adds to that year's amount. So it can just keep growing until they get paid. And that way, if any dividends are paid out, they're first in line until they get caught up, and then the common shareholders will get something. If there's any dividends that are not paid in any given year, those are said to be in arrears. You might see that. All right. So you might see dividend rights in dollars per share or percentages of par. Okay. I changed the way I have us calculating dividends per share because I had a lot of folks saying they didn't understand the old way. So they didn't like they were confused by this way. So I have printed out a copy of the old way, and we can do it both ways, and y'all can tell me which one works better. Really, honestly, these are just worksheets that I came up with. You calculate it however works for you. If it's easier for you to do it on a blank piece of paper and come up with the answer, that's fine. I mean, it just doesn't matter to me. I probably could have added, not to mention there's a couple of lines on the sheets on the screen that you may not have because you have room to write that in. But as I was going through, working through those examples, I realized that we needed to line. So you were going to see something extra up there that you did not have on your sheets. Okay, and if you're watching this video, those are going to be in the current week module I think it's in the preparing for class. It's under the worksheet. You can tell by the name what I named it, what it is. Okay, so let's look at this. Calculating dividends per share. All right, and what we're doing is we're saying, okay, for each share of preferred stock, this amount was paid in dividends. That's what we're looking for. That's our ultimate goal. And for each share of common stock, this was the amount of dividends that were paid in this particular year. Sorry, you've got year 1, 2, and 3. Those are the actual total dividends the company paid out. We've got to determine who got what. That's the purpose of the exercise. All right, so first thing you have to do is determine what are those preferred shareholders' rights. Okay, so Rainier Company has 30,000 shares of cumulative preferred 2% stock, $50 par. It's a long description. And then they have 110,000 shares of $20 par common stock. Okay, for this exercise, they give you $20 par for the common stock, but we don't have to use that, so don't let that confuse you. It's extra information. We will use all of this for preferred, because remember, they got rights to receive. It's kind of like they get first dibs on the dividends that come out. And that, what we're going to do is figure out for each share how much do they get. What's your question? Oh. All right, so here's your formula. We're going to take par value of preferred stock, multiply it by that percentage. That percentage represents the percentage of par. It's a dollar amount that you're going to get doing that. Let's see. What was par? 50 or 100? $50 par, 2%. So how much is that? How much is $50 times 2%? I think it's $1. Yes, $1. Okay, that comes out to $1. So essentially what that tells you is each share of preferred stock has first rights to $1 in dividends per share when there's a distribution made. So what we'll do is multiply that times the total number of preferred shares out there to figure out, okay, this is the total dividends going to all the preferred shareholders. So we've got 30,000 shares. That one's pretty easy. So $30,000 a year represents the rights of all the preferred shareholders. They get the first 30 grand of any dividend distribution. If anything is left, the common shareholders get it. If they don't, if the company doesn't pay out 30, then whatever the shortfall is rolls over to next year, and they'll get 30 plus that shortfall. Does that make sense? Okay. So I don't know that this is exactly the best presentation of this. It's the same numbers. If this starts to confuse you, look at that other worksheet I gave you, because it may make more sense. All right, so dividends paid out by the corporation in year 1. How much was that? $15,000. So they paid out $15,000. So we need to subtract the preferred shareholders' current dividend rights. So every year it's going to be 30. So if the corporation paid out 15 and the preferred shareholders get first rights to 30, how much are the preferred shareholders going to get? 15. Okay, so this leaves a deficit. So what we could say here is preferred paid 15. They were paid 15,000. Common paid nothing. There was nothing left. Does that make sense? Because what I said was, do you have a negative balance? Then that amount is what is due to the preferred shareholders next year. I mean, we're going to roll it. But I don't know that I put enough information on here. It's kind of confusing. Is this making sense? Sort of. We may have to do it the other way too to see. Okay. So in year 2, what were the dividends paid out in year 2?
50,000.
50,000. So 30,000 is the amount that goes to the preferred shareholders for that year. What was left over from the year before?
20,000.
Is 15.
Oh, geez.
15. So we have 5,000 left. I guess essentially what we're doing is calculating how much the common shareholders get. Because it's almost like I left a piece of it out or something. All right, so the preferred shareholders, how much did they get? They got 30,000 that they're supposed to get every year, plus for year 2. Are y'all totally lost? Yes? Is this bad?
I think you have an extra.
I do. Huh? I do. That's what I told y'all. I have an extra line on here. So when you get yours, you're going to have an extra line to write in. Yeah, I told y'all that when I was passing them out. Okay, so 15,000 from year 1. So the preferred shareholders got paid 45. Does that make sense? No? Yes? Abandon this process and move to the other one? What are y'all thinking?
I'm not the person that asked if that works.
Abandon this one, move to the other one?
I don't care.
Are y'all lost?
I'm good.
Yeah, it makes sense to me.
It makes sense to you? All right, let's work through it this way, then we'll work through it the other way. Okay? All right. So for year 3, how much do your common shareholders got 5? For year 3, how much total was paid out?
100,000.
How much?
100,000.
100,000. And your preferred shareholders got 30. There was nothing carried over, so that left 70 for the common shareholders. Does that make sense? See, it's going to make sense to some of you, and to some of you, it's going to lose you. So that's why I was thinking. But the other method I used to use, some people got it, and some people are like, I don't know, I don't understand this. Now we have 2 methods. Take your pick. All right. Because neither one of them, I'm not testing you on your method, which one you use. I want to know, can you figure out what dividends per share are each year? That's your ultimate goal. All right. So on year 1, get my answers out. In year 1, we had 15,000 paid to preferred shareholders, right? So all we're doing here is summarizing what we just calculated. In year 1, the preferred shareholders got 15,000. That was all that was paid. Common shareholders got nothing. In the second year, preferred shareholders got 45. Common shareholders got 5. And in the third year, preferred shareholders got 30. Common got 70. Once the preferred shareholders are caught up from anything that's in arrears, the most they're going to get for any given year is 30. So they stop at 30. So if the company pays out $1 million, all they're going to get is 30. So it could be good to be a preferred shareholder. It could be bad. It just depends on the circumstances. All right, so dividends per share. You're just going to divide. We got 30,000 shares of preferred is up in the problem, and 110 of common.
Basically, it's a lot less risky for your preferred shareholder.
Yeah, it is as far as dividends go.
But you're not.
If you're wanting to get dividends, if that's your goal is to get paid dividends, yeah. But you're not guaranteed that you'll receive those. You just have rights to the first dividends coming out.
You'll also now make a lot more money.
You're capped out. You know, once you get that amount, you're stuck. All right, so this first year, we'll take our $15,000 that was paid out to preferred shareholders and divide it by the number of shares. So what does that give you? 50 cents a share. So each share of preferred stock got 50 cents in dividends. Kind of stinks unless you've got a lot of shares. But then on the other hand, the common shareholders got nothing. What? You're dividing. That's a division. You want me to put a slash instead?
I still looking at saying 96 right there.
Huh? Huh?
I was about to say 96 right there.
You don't. You divide. Why would I subtract it? Think about it. We got this much money in dividends total going out. We got that many shares. I'll actually use logic. I'll do a slash instead. How about that? Does that make more sense? That look better? It was a divide thing. You used the little box are small. All right. And the next year, you've got 45,000 divided by 30,000 shares. So how much do I have that year? $1.50. Now I got 5,000 for my common shareholders divided amongst 110,000 shares. That's not going to go very far. It's like 4.5 cents. I put 0.045. It's like not even a nickel. That's really crappy. And then on this last one, $30,000 divided by 30,000 shares, they're getting $1 a share. And then 70,000 divided by 110, they're getting 64 cents a share. So y'all are totally confused?
No, 9.
Huh?
9.
Not anymore? Okay, good. And see, the thing is, you don't have to go through all those steps if you don't want to. I mean, you can write the dividends paid across the top and go, okay, well, since they only paid out 15, they're getting it, and I'm gonna have to carry the difference. So, you know, you don't have to do the steps. It's just kind of, I don't know. Those are always methods I'm just coming up with to try to help you. If that throws you off and you can think of a better way, do it your way. I mean, I don't care. You're not gonna have to fill out my steps on a test. What I'm gonna ask you on a test is this right here. You're going to have that information and this right here on the bottom, these bottom 3 blocks. That's all I'm going to ask.
Well, and how to find them. Preferred dividends.
What about it?
Well, we're going to find preferred dividends, right? Like the number.
Yeah, you're just going to have to give me dividends per share. Okay. Do y'all
I'm
want to?
saying like the top part, so like 50 to,
Oh, yeah. Well, yeah, you'll have to know this, but my question is going to be, what were dividends per share for each year? So yes, this is part of that calculation, but this is what I want. So you can do that on your scratch paper. Y'all want to see it the other way? Yes.
Works either way for me.
It's not gonna, I don't think it's gonna mess you up. Let me get in here and find it. Hang on. What? Let's see. Think about the best way to do this.
Works either way for me.
Yeah, I mean, we all rationalize things differently, so it's like, what are they? Okay.
I keep saying car and not think per.
I'm not seeing.
Makes more sense.
Okay, what
It's like per than car.
That's it. It's got to be it. So this is in your modules, and it's called Old Way to Do It or something. It's got the videos that go with it. So, all right, let me do. Come on, add a page, insert, and out. If it starts to confuse you, just plug your ears. Just confuses you, plug your ears. All right, so this is the same, it should be the same problem. Okay, this is just info, and that's telling you how to calculate those things. All right, So here's example 1 again.
So we just did.
This is the same thing we did, just this is gonna be a different worksheet.
That's literally what we just did.
Huh?
You
Oh
just-
crap, is it? Oh no, please tell me.
You just switched over to this. And then you.
No, this is different. This is different, trust me. Okay,
No, it isn't.
it is.
You know, put it in your table, right?
Yes, we literally just.
It's different.
I don't know, what's the?
It's the same problem, it's a different method. This is on the bottom of the other one. This is a different worksheet here. Okay, just bear with me. All right, we got $50 par, 2%, which we said was $1, 30,000 shares. This is the same exact problem. So we got $30,000 a year in dividends for the dividend rights. We're gonna do this second. First, we're gonna come down here and figure out how much is going to the preferred shares. So the first thing says preferred dividends payable current year. So how much is payable for current year? 30 grand. It's gonna be that way every year. So you could essentially write it all the way across if you wanted to. All right, the next line says preferred dividends payable from prior year or unpaid from prior year. Well, year 1, we don't have any. We don't have any in arrears because this is the first time we're calculating it. So what is payable for this current year is $30,000. And I'll use payable loosely because it's not guaranteed. It's just, all right, so how much was paid in preferred dividends this year? Well, let's look. And you can fill in your amounts here if you want. This is the total amounts distributed. 15,000, 50,000, and 100,000. So when we look at that, we've got 15,000 that was paid this year. So all of it is going to the preferred shareholders. So that leaves 15 payable for next year. Does that make more sense? No? Huh? Do what?
I was missing the second one.
Does this make more sense or no?
No,
Yeah.
I think that's-
All right, you choose, whichever works for you. All right, we can kind of go ahead and do this down here now just to get it out of the way. Okay, so in year 2, dividends payable from prior year. You're going to take this amount here and add it to year 2. So now we have $45,000 payable to our preferred shareholders. So let's look and see what was actually paid. It was 50. So all of it's going to get paid this year. We have plenty to cover it. So now we don't have anything to carry over. And then in this year, we don't have anything to carry over because it's 0. So it's going to be 30,000. And there was plenty paid to cover it. So you'll use this line right here, tells you how much you were paid, how much preferred dividends were paid that year to cover this current year and anything in arrears. So this is the amount you'll use to take to that top part. Okay, so how much was paid in year 1 for preferred dividends? $15,000. Common dividends, none. Okay, year 2. Preferred dividends paid $45,000. So that leaves 5. So you've got the total up here so you can subtract down. All right, then year 3, we had 30 that was paid to preferred, which leaves 70 for the common. And then you just do your division the same way based on this piece right here. It's very similar. This part's very similar. But this part is in place of the other steps. So which one? Either one works for you?
Yeah.
And you ain't got to use them at all. If you can just scratch it to the side, do it that way. The whole purpose of this is to help people through the thought process. If you can cut from A to Z real fast, you ain't got to even use any of that. Because this is what I'm interested in right here. I mean, essentially, you could just do this. You could do this part and get the answer. The other part is to help people understand the whole arrears thing, where if you don't get it all, you have to carry it over to next year and add it to it. Yeah.
So on the test with this question, are you gonna have like, is it just gonna be what is asking how much they get?
Yeah, this right here.
Okay, so none of the rest of it will be on there. Okay.
Because like I said, that's just worksheets to show you methods. All I'm gonna ask you is, I'm gonna give you all this information like up here. Rainier Company, blah, 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 this is what was paid out. What were the dividends per share paid? Year 1, year 2, year 3, preferred shares, common shares. Does that make sense? Okay. So which one? Neither? You like this one better? You like this one better? Anybody hate this one? Anybody hate the other one? Okay, so going forward for the next example, which one you want to use? This one or the other one? This one? Do I have any nays? Yays? Who, if you don't,
You tell me I don't have to write it all.
no, you ain't got to write it all out. Just solve the problem.
I don't care.
But you know, some of us go the long way around to get to the answer. Some of us go right to it. That's not me. I have to learn it. How is it done? Then once I get to that point, maybe I can go, oh, I could have just done this. But I have to, that's the way my brain processes. Y'all all good with going forward with this one? If not, hold your peace. With this one? But it didn't confuse you worse, did it? Okay. It shouldn't have. I mean, it's just the same. All right, so this is the same problem that's in your worksheets, but it's also on that second method I gave you. Aquila Corporation has 25,000 shares of cumulative preferred $2 stock. Okay, so notice this one doesn't have a percentage, it has a dollar amount. That last one we had a percentage and we had par, we had to figure out the dollar amount. This one they give it to us. Because the worksheets that I did for that are the original ones, I forgot the blank. So they figured that out for you. So really you just have to take that $2 and multiply it by the number of, I like to do this. I have a tendency to want to take these shares that are right next to it for preferred, and it's not right. All right, so we've got $2 and we've got 25,000 shares. Who can do that math? Y'all can't, then I've traumatized you. Okay. If you want to, you can go ahead and write each year's dividends on here. Okay. I love how those pop up there. It's like, what if that was something confidential? Maybe I need to tell it not to do that. Okay.
Because it's really hard to read it from here.
Yeah, but it's on the video.
Oh,
I mean, I'm recording this. All right, so let's figure out how much, who's getting what. I mean, you might could just do it from here. If they're supposed to get 50 a year, only 35 is going out. They'll get all 35. You want to do the steps? She's got this look on her face like, you didn't do it. You skipped it. Okay, let's go down here. Preferred dividends payable for each year. It's going to be 50 a year. So you can go ahead and just, that's how much they have first rights to every year. If any dividends are paid at all, they get first rights. They're first in line for 50 grand. And once they get their 50 grand plus anything that's old, then they're done. They don't get any more. All right, preferred dividends payable from prior year. Year 1 is nothing. So their rights payable are 50. Well, since they only paid 35, then that leaves me with 15 to carry over to next year. And so we'll carry that over to next year. So next year, how much are they paying out? 65, so they're getting all of it. but that covers it. That takes care of their balance, essentially. And then in year 3, how much was paid out? 110. So, there's nothing payable from previous year. 50 is what they've got first rights to. Plenty was paid out to cover that, so we'll just put the 50. And then, we can move our answers up here. All right, so year 2, they received 65, the preferred did. In year 3, they got their 50. Okay, so year 1, nothing was left over for common. Year 2, nothing was left over for common. Year 3, common shareholders actually got 60,000. I mean, so essentially, you really could just go through this part of the process if you're good with it. If you need to go through the steps, you do the steps. All right, so how many shares of preferred stock do we have? 25?
25K.
And was it 80 of the common?
Yeah.
Okay. So you'll divide 35,000 by 25,000.
124.
You get $1.40. Remember, these are dollar amounts. This is dividends. Common gets nothing. 65,000 divided by 25,000. $2.60. And then this particular year, they're going to get their $2. They're $2.
The other people will get 75 cents.
And yeah, the common shareholders get 75 cents. And the thing is, you're going to see a lot more common shares issued by a company than you will preferred. So it kind of dilutes everything.
But you're not just going on one stock. You'll typically have like
Oh yeah.
1,000 shares. Or
Yeah. But there's always going to be more common stock issued than preferred. Okay, so there's a third problem in here. I promise. So y'all work this one either way and see if you have the idea here. Use whatever method you want or no method at all, just figure it out. This one's easy to figure out. This one you almost don't have to go through any steps. And if you'll look at it, oh, sorry, that's not right. It's $1 a share. I knew that didn't look right. If you'll look at this, the preferred shareholders getting 50,000 a year. Every year they're paying out plenty to cover it. So there's not going to be anything left in arrears. So this one's actually easy. Because if you put I have not the whole problem here. You've got 105. So check that before you do a whole lot of legwork. And then you have 160. So there's not going to be anything left over. So they're going to get their 50 every year, and that's going to be all they get. See, if you put 50 here, all you have to do is subtract to get the difference. So this one's, does that make sense? Go to the steps if you want to. It's okay. I understand. Trust me. That's why I'm laughing at you, because I get something set in my head, a certain way to do something, and it's hard to get me to budge. I have a friend I used to work with at the first firm I worked for, and she is like super quick. So my method of figuring something out is like go around this way and then this way, like the steps. And her way is like, bam, before I can even get to the end of it, she's gone straight there and got the answer. I'm like, no, what? And I'm talking about complex stuff. So I just walk away rolling my eyes. I'm like, you're going to have to give me 15 or 20 minutes to get there. I don't think like you do. She was sharp. Not saying I'm stupid, just her the way her brain processes problem solving was super quick. She just, it was amazing. I was like, I take her stuff and go, what is this? Save me half an hour. And then some things I was quicker on. It just depends. But some of it I have got to go through the process of rationalizing it. I don't know why. All right, so there was 50,000 shares of preferred, 130,000 shares of common. Well, essentially, since they got their rights every time, this is $1. Got 100 times 1%. So this is just going to be $1 all the way across. I don't think I thought this out real carefully when I made this one too easy. And then 42.
Yeah, you did.
What made it too easy? 15 and 85. Okay. Y'all kind of get the idea of if they don't pay enough, how to carry it over and all that? Okay. All right. I'm done with you. One thing I do want to say though, on the test, when you were calculating how much net income went to a partner based on salary and interest, I told y'all, I don't know how many times, don't calculate the interest on the salary allowance, calculate it on the capital balance. And I mean, I can't tell you how many more people did it the wrong way than did it the right way. More people calculated interest on the salary allowance than they did the capital. Even though I said it like 10 times, y'all got to, if I'm telling you something, y'all got to clue in on it because it'll save you some heartache. All right, y'all have a good one.